Inflation remained relatively subdued in March 2015, with annual core inflation edging up 3.7% in March from 3.3% in February 2015. The rise in core inflation was in part driven by a pass-through effect of the exchange rate depreciation on the prices of imported goods. The annual headline inflation also rose in March to 1.9% from 1.6% in February 2015. The low rates of headline inflation are mainly attributable to the negative food crop inflation, which was the result of a good harvest in 2014-15. Indicators of economic activity point to strong real gross domestic product growth in the first half of 2014-15, supported by faster growth in real private sector borrowing. Although economic growth may have slackened off in the third quarter of the current fiscal year, actual real output is now estimated to be slightly above the potential level of output. Real output growth may accelerate over the medium term, stimulated by higher public investment spending and private consumption, pushing real output even further above the potential, which may exert upward pressures on prices for goods and services in the domestic economy. The balance of payments is a source of weakness in the economy, and this continues to be reflected in the pressures on the exchange rate to depreciate. The current account deficit remains large and is likely to be in the region of 8.5% of GDP in 2014-2015 financial year, despite savings on the import bill as a result of lower oil prices, whereas financial account inflows have weakened over the last few months. Over the medium term, the current account will adjust to ensure external balance. The Bank of Uganda expects it will intervene in the foreign exchange market to curb disruptive volatility in the exchange rate, as was the case in March 2015. But the bank will not try to impede the real exchange rate from adjusting smoothly where this is needed to maintain external balance. The depreciation of the exchange rate and faster real GDP growth will exert upward pressure on inflation over the medium term. The Bank of Uganda now forecasts that core inflation will rise to around 5% by the middle of 2015, and in the absence of any adjustment to the monetary policy stance, will rise to a range of 7.9% by June 2016. Furthermore, the Bank of Uganda judges that the balance of risks to the inflation forecasts are on the upside, especially because of the potential pressures from the exchange rate depreciation. Therefore, to forestall a rise in core inflation over the medium term above the policy target of 5%, the Bank of Uganda will tighten monetary policy by raising the central bank rate by 1 percentage point to 12% immediately. The band on the CBR will be maintained at plus or minus 2 percentage points, and the margin on the rediscount rate will be maintained at 3 percentage points on the CBR. The rediscount rate and the bank rate will therefore be increased to 15% and 16% respectively.